This is Trading Matters.
Well, it is time now for our daily segment, Trading Matters. Roger Montgomery is joining me now. He's an independent analyst here with me on set in Sydney. Roger, good to have you with us today.
Thanks, Oriel. Nice to be here again.
Initial thoughts? The AIO Energy deal, what do you think? I mean, shares are up, what, 46% as we just saw?
How do you value something like that? You know, it's such a difficult thing to do. Certainly as a going concern, the way I value businesses, the valuation is nothing near the price that's now being paid. That tells me that it's a generous price, and to hear that the board has immediately come out and said take no action means two things. Either they've yet to have time to assess the merits of the bid and the structure of it, or they don't want to lose their jobs. So it's one of those two things. Nevertheless, it seems to me, the way I value companies, it seems to be a very generous offer.
All right. Okay, Roger, let's get off the news and talk trading now.
Sure.
Now, of course, you talk about valuations most of the time when we see you. I'm interested in these stocks that you've sent through to me. Absurdly, I should say, expensive.
Absurdly expensive stocks, and you've got the list there.
I've got the list
IAG, AMP, Wesfarmers, Lend-Lease, TOL, Santos, Asciano, RIO and Leighton's, all very, very expensive at the moment. In fact, when I look at the market and I collate and aggregate all the valuations that I do, and I take the top 200, what I've found is the market's probably about 15% collectively or in aggregate overpriced. Now that, of course, is not a prediction about where the market's going to go. I don't know what the price is going to do, but I can tell you that if you're a trader, you want to take long positions in stocks that are underpriced, and you want to take short positions in those, pardon me, that are overpriced. And there's a list of overpriced ones. Now, I've also given you a list of those that I think are fair value, and there's a few there.
What do you do with these?
Well, here's the thing. I think, you know, Flight Centre and JB Hi-Fi and Woolies are good businesses, and they're fairly priced. They're not at big discounts. I prefer to buy things at substantial discounts to their value, so that means right now I'm not doing anything. But then a couple of the others I know are popular. Telstra, for example. People have been buying that since $3.50, and I remember hearing all the commentary was the dividend yield's really good. And I think I was here on your show with Anton Tagliaferro, and I said, look, I don't like it. And that was back in, I think that might have been in October or November last year.
Last year, yes.
Yeah, exactly. And the share price was a lot higher than where it is now. And I didn't like it then. I didn't like it for its dividend yield. I don't think you should buy mediocre businesses because of a good dividend yield, because ultimately the dividend yield will catch up with the performance of the business. So Telstra now is fairly priced, but not a great business. So there are some that are fairly priced and are good businesses, but I'd like to buy them at discounts. The others that are fairly priced are not great businesses, and so even though they're at fair value, I wouldn't be buying them.
Okay, well, let's break this down then. Sure. Out of the ones that you've got here, I mean, you've got 1, 2, 3, 4, 5 stocks on this list that are fair value. Which are the ones that you don't like as businesses?
Well, Telstra is a classic example of a business that I think is no good. QBE, I think it's an excellent business, but its intrinsic value over the next 3 years is going to be about the current price. So one of the things that you want to do is you want to buy a great business. You want to buy it at a big discount to its value, but you want to buy a business whose intrinsic value is going up a lot over the next 2 or 3 years. And QBE, based on the forecast that I've got and the announcements that have been made, at the moment, unless they make a really great acquisition at a really cheap price, well, it looks like its intrinsic value is going to be about the same.
Okay, and that's QBE. I want your opinion, please, Roger, on this trader's tip. But let's let our viewers take a listen to it first. Here we go.
You won't see Jen Hawkins or Megan Gale gracing its catalogues. The Reject Shop prefers to titillate investors by delivering strong profit growth, and is on track to post its 8th consecutive year of profit rises in 2010. A key driver is its aggressive store rollout program, for which the company has plans to double its national footprint to 400 stores. The stock attracts a premium PE valuation, but in our view is justified by its growth potential. We rate the stock a buy with a $21.50 12-month target.
What do you think?
$21.50. Gee, I'd like to see that. I should let you know I used to be, on behalf of my clients and my funds management business, the biggest shareholder in the Reject Shop. I bought its shares at $2.40 back in 2004. I've known every CEO, and I know the current one really, really well. I think that price objective is optimistic. I hope he gets it right. I think it's a little bit late in the story now. The intrinsic value of this business is rising over the next couple of years. But of course what tends to happen is when businesses roll out stores, and they've got a lot of stores to roll out, they tend to take the best sites first. So that later in the story, the stores that are purchased or leased, rather, and set up tend to be less attractive than the early stores. They tend to be not as profitable, and so then what you see is a flattening out of return on equity. If that happens, then the reject shop has hit its peak, and these discount variety type stores, they are very, very good at making money during their rollout period, but once that return on equity flattens out, well, you only need to turn to the United States to see what's happened there.
Well, you said to me just then you've been a shareholder in the reject shop since 2004, so I guess what sort of time frame? You know, if shareholders do want to jump on board now, we're sitting at around the 15.55
Sure.
level. I mean, you know, how much room have they got?
Well, look, the trick is to buy businesses that you think have bright prospects over the next 2, 3, 4, 5 years. And when I bought the reject shop in 2004, that was the story. You know, it had wonderful prospects. Mind you, it's generating a return on equity of about 70%. So irrespective of its profit growth, its profitability is amazing. You would want to know that the value of this business is going to be at least 15% higher than it is currently over the next 12 months, and that is the case. But beyond that, it starts to flatten out.
Okay. Earlier on in our conversation, Roger, you said you're not doing anything right now. Nothing at all.
I have raised a lot of cash. I've sold a lot of things. Now, that's not because I'm making a call on the market, which I know all of your viewers are interested in. All I can say is that when I look at the market, it seems to be expensive. Most of the companies that I like, the really top quality businesses, they seem to be expensive as well, and they've been very, very good returns over the last few years.
Okay, too expensive.
Yeah, too expensive.
All right. Roger, as always, a real pleasure to have you with us.
Thank you again.
Thanks for joining us. Roger Montgomery with me there, an independent analyst.